Welcome to Taoists. The purpose of this recording is for educational and entertainment purposes only. None of this is financial advice.
All right. Hello, Taoists. We are here today with Dr. Richard Smith. He is a mathematician, a behavioral scientist, visionary founder with 20 years of investing and trading experience. He's going to be joining us today to talk about something everyone deals with every day, risk. Richard, are you with us? Can you hear me? There he is.
Hello. Do we have contact?
Hello. Can you hear? All
I
right.
can hear you.
Yes.
Excellent. Sounds good.
Great. The universe is aligned. I just gave everyone an intro on you as a mathematician, a behavioral scientist, a founder with 20 years of investing and trading experience. I hope that's still accurate.
That covers a lot of good ground. I'd say that covers a lot of the past 30 years.
Excellent. Well, one thing I was interested in seeing was that, like me, you are a product of the SUNY system, the State University of New York.
That's true.
I went to Stony Brook.
Okay. Yeah. Well, I started out in the University of California system. I studied math at Berkeley there, and then I got my PhD, in a field called systems science. And systems science is a field in which you are trying to develop, ways to solve problems and ways to think about things in a little more holistic way, a little less reductionistic way, right? And look at the systems as a whole instead of always trying to break everything down into parts. And so there's only 2 system science PhDs in the country, and one of them is in SUNY Binghamton at the Watson School of Engineering there. So yeah, I spent a few years in the cold Lake Snow area of Binghamton, New York.
Very nice.
It was good.
Well, I guess you got the best of both coasts. Now you're working on something called RiskSmith. Can you tell us a little bit about what that is?
Absolutely. So my PhD was in, the topic was decision making under uncertainty, right? So how do we make decisions using math, using computers, using algorithms, especially when we really don't know what the outcome is exactly going to be, right? When we can't get to one answer. And so that's what I worked on in grad school. And then I got my PhD in 2000, and in 1999 I was killing it in the stock market during the dot-com boom, and I was up 300 or 400% at one point. And then March of 2000 hit. I ended up getting my PhD in June of 2000 and getting married in June of 2000. So 2000 was a big year, and I gave back all of my gains. And that started a lifelong fascination with investing. But really, investing is one of the ultimate areas where we are faced with, fundamental uncertainty, but also with a lot of data, right? So it's an incredible area to explore in terms of decision-making under uncertainty using data and algorithms and computers, et cetera. So that started me down the road of really getting interested in investing. I ended up developing some software along the way that had 30,000 customers tracking $20 billion of their own assets on the platform, and did that for about 15 years, exited that business in early 2020. And now I'm building some new financial technology under the RiskSmith brand right now. And what it's really about is helping people, especially us, the lay people, not financial professionals, to be able to leverage the tools of professional risk management in our investing and trading decision makings. I think it's even more broader than that, and that's what I look forward to really getting into you this evening about. But I think that risk management is something that's really very poorly understood. There's a lot of risk illiteracy, even amongst educated people, and yet it's an incredibly powerful set of tools that no professional would ever be without, and yet it's completely absent in the public dialogue for the most part. So I'm out to change that, and to make it more accessible through great technology, great design, but also through great education that I think kind of reframes and repackages the value that risk management can bring to all of us. And I think it has some really interesting overlaps with DeFi.
Yeah. So you call this democratizing risk management, right? Well,
Yeah.
I mean, we're democratizing a lot of things
Right.
with
It's a popular
blockchain
word these days,
days.
right?
Yeah, it
Yeah.
is. It's definitely a catchphrase. But what does democratizing risk management mean to you? Does that mean
Well,
spreading the risk
it,
across a lot of people, or is it?
no, it means educating the public about it and getting these tools into the hands of the public so that the public can use risk management more effectively and not be so. Right now, I believe that risk management has essentially been weaponized against the public by the risk literate financial world. And so this is something we can get into. But after 15, 20 years of helping literally tens of thousands of investors, studying thousands of portfolios, back-tested portfolios of real individual decision makers, what I learned is that the biggest obstacle to successfully participating in capital markets is that we're constantly taking on risks that we're not comfortable with and that end up putting us in kind of a reactive relationship with the markets. And it, it's very destabilizing for us. And I think a lot of that is done more or less intentionally by other players in the markets who know, hey, if we create this kind of pattern in the markets, it's really going to, throw a lot of weak hands off their game, so to speak, and it's going to cause them to be reactive and unstable, and then we can take their money. So,
Right.
that's one of the aspects of the markets, right? So,
Yeah, right. So it sounds like what you're saying is that those who understand risk and those who know
absolutely.
how
Yeah.
to manage risk
Yes.
are at an advantage in this
Yes.
game.
Absolutely. And it's
Yeah.
not that hard,
Right.
especially with technology and design today that allow us to, you know, um, use technologies and tools that we couldn't use before, even if we don't know all the math behind them, right? So how do we really get the tools of risk management and the visualizations of risk management? I don't like the term risk management as much as I like the term risk design. I think risk design, and this is a good example, Igor, of how I'm repackaging the message here of, risk management sounds sort of, like risk is a bad thing that you have to manage, right? That's how most people think of it. I don't think of
Hmm.
risk as a bad thing at all. I think of risk as a super positive thing. And it's fundamental to our economy, fundamental to our lives, inescapable. And what we can do is we can start designing risk, right? We can start designing risk to work for us and to meet our needs and to be aligned with our own, risk tolerance and place that we are in life and, our capital that's available to us, et cetera, et cetera. So that is a good, I
Yeah.
think, way of thinking about it. We can design risk,
Yeah,
and
I definitely,
that's
yeah,
what
I'd
I'm
agree that
hoping to
there's a
do.
stigma, right? There's a stigma
Absolutely.
around the word risk, but those that are financially literate realize that risk is something you deal with every day. Every financial decision you make has some sort of element of risk, and the upside of that is reward, of course. Do you see
Absolutely.
those as like, the yin and the yang of investing?
Yes. Just a quick funny story around risk and the stigma of it, right? Like I was telling my mom what I named my new company. I said, I named it RiskSmith. And she said, Risk? R-I-S-K? Why would you name it that? Risk isn't a good thing.
It's just one letter off from your name. I mean,
Right. And but that is the way most people think about it, you know. And part of the confusion is that risk means different things, right? In one sense, risk, the sort of common use language, what we mean by risk is something bad happening, right? So like losing money is a bad thing, right? But when it comes to financial decision making, risk is more about kind of the spread of possible outcomes, right? Some things like investing in bonds have a tighter, range of possible outcomes, whereas investing in altcoins have a wider range of possible outcomes. So that, you can quantify that risk. It's not the same thing as saying, you're going to have a bad outcome, because ultimately what risk design is about is kind of managing the distribution of risk in an optimal way so that you can convert that risk into reward. We are out for reward. It is about reward in the end, but you don't get reward if you don't take risk. Right? That is the fundamental law of the markets, right? And really, if you think about it, that's why the markets exist, right? Companies go public, or people raise money for tokens because they want to spread the risk around, and those with capital can take a part of that risk and earn a reward in exchange for taking on some of that risk. That's the definition of markets, right? That's the definition of capitalism. So, we have to learn to manage and design risk in an optimal way so that we can convert that risk to reward. That's the job of any investor, any trader, to take smart risks that have the best chance of converting to rewards.
Right. Well, that's certainly the definition of investing. And a lot of people don't necessarily realize that this is why venture capitalists, have the potential to make such high returns, is because they take such high risk.
Absolutely.
The amount of money that they put into a startup company at the inception or at a very early stage obviously comes with a lot of risk. And so anytime you, I think, negotiate any kind of business deal or really anything, you have to take into account the counterparty's risk. But it sounds like in the space of crypto specifically, there is an imbalance. I mean, if you think about specifically some of the more traditional cryptocurrencies, if we can call them that, Bitcoin, maybe even Ethereum to some degree, there's a lot of institutional investment there that really knows a lot more about how the market works and fluctuates than the conventional investor, the individual who's just getting started in this space. Is this something that you think RiskSmith could help change, the idea or the imbalance of the whales in the marketplace that realize that, there's a cycle to this and they're just going to play off of anyone who jumps in at a specific peak media cycles?
Yes, absolutely. Because what it's really about is having accurate expectations about what the range of possible outcomes is and investing accordingly. So going back to venture capital for a minute, just as an example, because I think this is a really illustrative example, like venture capital companies, they tell you right up, if you're going to invest with them, that your money is going to be locked up for 10 years. Right? And they tell you we're going to be investing in very speculative companies And we expect, 8 of them to go to 0 and 2 of them, to go to 1,000% or higher, right? So that's very clear expectations that allows them to then successfully, put their attention and put their capital into these speculative swing for the fences opportunities, because they're honest about what kind of risk they're dealing with up front, right? So meanwhile, the average individual who's learning about Bitcoin today, right, is getting caught up and hammered really with FOMO, right? Like, hey, if you don't get in now, man, this thing's going to $1 million and you're going to be left behind. Hey, it might become the next reserve currency of the world. So if you don't get in now and the dollar goes, to 0, man, you're going to be left behind. So, that is an example of FOMO. That's a narrative I've heard plenty of times. I don't think I'm just making it up. And what it does is it creates a lot of anxiety, and it draws people into a relationship with Bitcoin that is not realistic about the range of possible outcomes for Bitcoin. The first thing I tell people that want to invest in Bitcoin is that, anything that you might put in Bitcoin, you need to be perfectly fine with it falling by 50%, in a matter of weeks, and that being okay, right? So that's happened in the history of Bitcoin. It's fallen 80 or 90%, right? It could happen again. It's happened. There's been a few cycles of that in the life of Bitcoin already. So that is about having accurate expectations about the possible range of future outcomes, right? And one of the most powerful risk management tools in the Bitcoin world has been the idea of HODL. Hold on for dear life, never sell, right?
Yeah.
That has made more, people wealthy that never would have gotten wealthy in, a regular relationship with the markets, because of hodling, which basically says, it's going to go down 50, 80, 90%. It's going to go up 1,000%. Whatever happens, I'm okay. Right?
Yeah. Well,
And
it
now
sounds like,
look how that's worked out.
yeah, it sounds like you're saying that, FOMO is not an investment strategy.
Oh,
And
it's not. It's a
it's
marketing
not.
strategy.
So it's not like FOMO equals this is going to go to the moon, which is blowing a lot of people's minds right now. I'll
Right.
let you know.
Right. Absolutely.
But I think that's a very good point, and ultimately, the ecosystem, I think, exists to somewhat disrupt the traditional paradigms of stock exchanges and institutional investments and investment banks and things like that the blockchain allows us to kind of replace with something more modern. But many of these similar types of tropes exist from that era. Aren't these just carryovers? The whales, the short sellers, right? Isn't this just kind of rehashed from the past?
Absolutely. And there's a lot of Wall Street that's moved over to the crypto space, and a lot of the same, approaches to profiting in a speculation are being applied today, as have been applied for, I don't know, couple hundred years in any speculative market. So, and there's a lot of institutional interest in Bitcoin. I don't know if you've come across Ben Hunt and his Epsilon theory website and blog, but great insights there from a very seasoned financial professional. And, he talks about Bitcoin and Bitcoin, so a lot of exchanges are making money off of Bitcoin today, right? ETFs, Chicago Board of Trade, or CME Group. I'm not sure which one runs the futures markets, but there is a lot of money to be made in creating churn in Bitcoin, right?
Right.
And in altcoins, right? And I personally hate that churn model. I hate that aspect of markets. I wish that it were less, prominent than it is. But really, in the end, Igor, that's on us. We get to decide if we're going to be part of the churn or not, right? And if you want to be a trader, if you want to day trade Bitcoin and you want to get in there and duke it out with, the heavy hitters, be my guest, But for the average person, getting in and getting caught up in that cycle of, fear and greed, it's not going to work. So I always say, look, I think it's great to hold a little Bitcoin, buy some Ethereum. If you want to get into altcoins and you're willing to do the research, and spend the time learning about them, more power to you, but make sure that whatever you do, you basically can, be okay if this goes to zero. Right?
Yeah, well, this is where we as consumers really have the power to disrupt.
Absolutely.
Thinking
And
about
that's why I'm
the
interested in DAOs.
Yeah, right, exactly. And Wall Street Bets on Reddit, how they took down the short sellers. I mean, this is what the community has the power to do as a decentralized autonomous organization, right? So our DAOs, I mean, we have certain philosophies and certain ideals that we try and follow, and one of those is data sovereignty, is giving people sovereignty over their own information. How does this play into risk?
I'm glad you asked, because where it leads me to is talking about, for example, Robinhood, right? So I know Robinhood has been an incredible entry point for many new people to get interested in the markets, and kudos to them for pulling that off. What troubles me, though, is that by giving free trades, somebody's paying for those trades, and who's paying for them are the wholesale market makers like Citadel Securities and Virtu Financial. Okay, so they are in between Robinhood and the stock exchange, right? They're wholesale market makers, and they pay Robinhood to execute the trades of Robinhood's users, right? I don't call them customers, because Robinhood is pursuing the user as product business model out of Silicon Valley, right? That's the Facebook model. That's the Google model. We don't pay them fees. We don't subscribe to their services. We are users, and we're the product, right? In Facebook, we're the product to be have our behavior modified so that it best profits Facebook's customers, which are their advertisers. And with Robinhood, the users are the product, and Robinhood is selling their users' data to wholesale market makers who are highly risk literate. Okay. So they're actually doing something that is called risk warehousing. So the market makers are getting a picture of the market through seeing all of this order flow. They're getting a picture of the market, and they're making bets based on the picture of the market of what all the other market participants are doing. So they have now, because of their access to data that the Robinhood users don't realize they're giving away for free, those centralized institutions that have much better data and much better analytics, much better risk literacy, much higher computing power, more PhDs, they're using that data to have an advantage over those of us who don't have all of that power and analytics and data, right? So this is what I see going on across the entire digital economy today, right? You have all of these powerful corporations that know the value of data, that are able to see things about us that we can't even see about ourselves, and that are using that to, with risk management. Because look, Igor, the entire digital world, okay, is statistical. It is statistics, right? Things get converted to bits bits get, put into databases, and we run analytics and get statistics on that data. And then, we make decisions based on those statistics and analytics, and we manage risk. Okay, that's what's going on. And look, artificial intelligence is statistics. Machine learning is statistics. So they're using risk management. And because we are risk illiterate, we don't realize, when we're taking risks that we're not prepared to take, or when we're not taking enough risk to earn the reward that we need. So this is what I see going on in the entire digital economy, is that the centralized institutions know the value of the data. They collect that data under all these terms and conditions that we can't even make sense of, right? And they are incredibly empowered by having all that data, and we're asleep at the switch by giving all that data away. So I think that we need to level the playing field here. We need to be in control of our own data. We need to realize the value of our own data for our own decision making, right? Because I see the digital world as kind of a parallel universe. Okay. And, we need to have personhood in that universe. It's a new world. The digital, the metaverse is a new world, and we don't have the concept of personhood in the metaverse. Okay. Facebook gets our data, Apple gets our data, Fitbit gets our data, Robinhood gets our data, Google gets our data, Tesla gets our data. I say
it's like Oprah Winfrey giving out free data to everyone.
Yeah, and the media companies get our data, right? Everybody gets our data. So to me, one of the most exciting and compelling aspects of blockchain and crypto, Bitcoin was the first ever experience that we had of being able to have digital sovereignty, right? That we had sovereignty over a purely digital asset, right? Bitcoin was the first time you could say, I own this Bitcoin, I control this Bitcoin, and I can prove it, and nobody else can, right?
Right.
So that was a revolution. That was a huge breakthrough, right? So now, though, we've gotten to the point of NFTs, right? And NFTs, non-fungible tokens, right? Your personal data, my personal data, can be a non-fungible token. It can be an NFT. I can have sovereignty over my personal data now for the first time ever. And we're not there yet, right? The scalability isn't there yet, but there's a lot more capacity than we've ever had for this to happen, where you can have true data sovereignty using blockchain. And I think that's a really powerful opportunity to level the playing field more between, the individuals out at the edges of the network and the centralized powers that up until now have completely dominated, developed unprecedented wealth and power. The gap between the haves and the have-nots has gotten way beyond anything that a society can survive. It's all going to hell in a handbasket if we don't, narrow that gap.
Yeah, no, absolutely. It's clear that we've hit a point in time when people are finally starting to realize that if they're not paying for the product, they are the product. But if everyone were to stop using Robinhood and these other platforms that are monitoring and building profiles and building intelligence, that doesn't mean that the information isn't going to be there. It's just that it's democratized. It's available to everyone equally, which is kind of a really important thing, especially because people don't realize that when they're investing with Robinhood, they're not necessarily buying a Bitcoin. They're not necessarily buying a stock. What they're buying is a percentage of theoretical ownership. But as stocks fluctuate up and down, one of the key elements inside of the blockchain, and one of the reasons that the technology for consensus exists and is so important, is to identify when a specific trade was made and what order those trades were made in. And why that's super important is because as something goes up or down in value, what's stopping Robinhood from taking 100 trades for the same security and putting their own trade at the beginning or the end of that block of 100 trades, because they know exactly what direction they're pushing the market in. So talk to me a little bit about how is it that we're talking about an entirely different paradigm with data sovereignty? Or is it what we're doing is really just democratizing it so that everyone has access to the same information, and maybe individuals can have exclusive sovereignty over their information so that they can choose who gets to see it? Maybe which doctors get to see their medical records, which financial professionals get to see their banking records or blockchain ownership records, or that sort of thing.
Yeah. And how can all of that data help us make better decisions, about how we allocate our resources in the digital world? Okay. Right now we're talking about capital, but we can also talk about attention, right? When we go online, how is our attention moved, from one click to the next, right? I mean, I don't know about you, but I can hardly get in front of my computer and even remember what I came in front of my computer to do because almost instantly I'm taken off on something that, I wasn't planning to do when I fired up my computer, and unlocked it, right?
Yep.
So we need to be more in control of how we allocate our resources. We need to be more in control of how we allocate our capital. We need to be more in control of how we allocate our attention. We need to be more in control of how we allocate our time, right? And right now, the centralized, silos have a huge advantage over us in terms of knowing how to modify our behavior towards their ends. So to me, I want all that data that I'm generating on myself. I want to build an avatar of myself so that I can know better how I interact with the online world. Okay. And then I can use that as almost like an AI coach to help me make better decisions when I'm online. And this is true in investing. Okay. So, for a while, I was a big enthusiast of a wearable called Whoop. I don't know if you ever came across Whoop, WHOOP. They measure heart rate variability and through a kind of Apple Watch type wearable. And they give you a great user experience around what they call strain and recovery. Okay. Every day you take on a certain amount of strain, and every night you achieve a certain amount of recovery. And it's a beautiful simplification of what, wearable analytics can do. It's a new user experience. And really, they were the inspiration for me to go, I'm going to create a user experience around reward and risk. Right? So they took heart rate variability and resting heart rate, fitness data, and they repackaged it in terms of strain and recovery, right? So every day, hey, did you take on enough strain today? And hey, how did you rest tonight? And what kind of recovery did you make? And are you ready to, hit it full blast today, or maybe take it a little easier today? So incredible, right? But then I started thinking about, how could that same data help me in my investing decision making, right? So every day, I'm in the markets, and sometimes it's long-term decisions I'm making. Sometimes it's short-term decisions I'm making. But I'd like to know if I haven't slept very well for the past 3 nights and my recovery has been very poor, my biometric data can tell me something about what's going on with me. and might help me make a better decision or not make a bad decision in the financial markets, right? Like, hey,
Right.
you haven't slept well for the past 3 nights. I know the market's down sharply today, but how about sleep on it before you decide to liquidate your whole portfolio, right?
Right. So it sounds like, I mean, we
So,
could even bring in another analogy here of atrophy. If you're not flexing your investment muscles, then you're going to deal with atrophy there
yeah,
as well. I'd like
absolutely.
to bring on a couple of people here, if you don't mind.
Happy
So
to.
we have, let's see, why don't we bring up Steve? Are you around with us, Steve, here?
Yeah, I'm right here.
All right, Steve, go ahead and shoot.
Yeah, Richard, great to hear, what you're all about and what you've been doing. It sounds fantastic. Delivering the ability for people to manage risk and utilize risk, it sounds
Mhm.
like. And I see that you've got a product coming out. So I get to twofold. One question is about, I always find it pretty amazing when I talk to people about when they hand over their public wallet address, what kind of information that provides to the person receiving it. So basically, any transaction ever made shows up in your public wallet, and people don't get that. When I say that,
Mhm.
they're like, "Oh, really?" Because they think that there's some anonymity to wallets and addresses. And I heard
Right.
you talking about providing ownership of that data. So I'm curious how that works, and then also curious about what level that who can benefit from what you're doing, what level of crypto holdings or financial holdings would you say it's most applicable for?
Sure. Great questions. And taking the first one about, sharing your public wallet and seeing all the transactions, yes. Uh, so we do need new technology that allows users to have more control over which of that data they want to share and which they don't. And there's a lot of innovation going on in this space already. I am an investor in a company called One Creation. They're not using crypto, but they're using blockchain, and they're working on a way. They're starting on the corporate side, but for corporations to be able to share their data with and have policies around, when that data is shared, who that data is shared with, what the revocation rights of that data are, et cetera, right? So there is a lot of work going on in this space already. Look, I don't think we're there today that we can have true data sovereignty and a new economy built around data sovereignty. But I do think that technology is being developed. And I think that, we'll see it in the next 5 to 10 years. And so, yes, sharing your public wallet, giving away, everything, that's not what I'm talking about in terms of data sovereignty. We need to develop technology that we can all use, that's intuitive, right? Where we can be in control of who we share our data with, and under what conditions, which, essentially are smart contracts, right? So, so I think that's coming, and I think that will change the way that we share data.
That's
Okay,
great.
so that's
Yeah,
number
we
one.
have thank you for that, Steve. We have Nakamomo, one of our contributors here at Taoists, had a question about what native crypto folks like us can
Mhm.
learn from traditional financial risk management.
Yeah.
What can we learn here that Wall Street's known about for many years?
The simplest thing is that you should be looking at volatility. You should be looking at, how much things go up and down, right? You should be looking at how different assets are correlated to one another, right? Do they go up and down at the same time, or is one go up while another one goes down, right? And building a portfolio is about bundling, ideally uncorrelated assets. And when you get what Ray Dalio called the Holy Grail portfolio of 15 to 20 good uncorrelated investments, right? That can really, bring your risk, which is, it's not so wild anymore. You can narrow it, okay? And then, you can live with that and still sleep at night and be more comfortable, in your own skin, right? Because where the problems arise is when we get something happens that we just weren't prepared for as a possible outcome at all. And then we end up making a reactive decision, right? So look, Ethereum, Bitcoin is actually calmed down a fair bit over the years. Ethereum is still regularly up or down 5% in a day, and that's just, the price of entry for being in Ethereum. Every day you put $1,000 in Ethereum, every day you're going to be up or down by $50, right? And you get a few of those down by $50 a day, and you'll start to get nauseous if $1,000 is too much for you to have invested in Ethereum, right? So getting to know your own risk tolerance, it's a function of the volatility of your portfolio as a whole, but it's also a function of how much money you put into those assets, right? So you can be, in a stock that's really volatile, and if you have, too much money into it, you won't be able to sleep at night. But you can also be in that same stock and put a little bit of money into it and be totally fine, because you are prepared. You know what to expect. You know what history has shown for these assets, right? So just knowing that, and it's a function not just of the volatility, but the volatility plus the amount of capital that you put in it. And then how do the pieces of your portfolio work together as a whole, right? So you can have two wildly volatile things that move, at opposite times, but overall are both still going up. And when you put those together, you'll have lower volatility. Okay. So allocating by volatility, I like to allocate my investments by volatility. I put more capital into the less volatile, and I put less capital into the more volatile. I sort of regard it as, look, you need your meat and potatoes, but you also need your salt and pepper and, maybe some jalapenos. Okay. But you don't make a whole meal out of jalapenos.
Right. So you don't necessarily, you're not against the philosophy of buying a little Doge here and there, but but don't don't expect to get rich overnight, and don't get freaked out if it takes a 50% drop. That's part of the part of the game. I want to bring Eric Mack up here. He's got some questions too, I'm sure. Eric, are you with us?
So yeah, I'm here. Thanks, Richard. And I guess I wonder where you see DAOs taking this space, say 2 years, 5 years from now, where this has become a more mainstream thing. How does that change the landscape?
Well, I'm actually also here to learn from you guys. So, I'm developing a new business, right? I have values that I believe would be supported by a decentralized, distributed approach. And I'm interested in NFTs, for example, and as a path to data sovereignty. And I don't know that much about DAOs other than that, they're distributed communities, right? So connecting with people that care about decentralization, right? Because I think we're too far on the centralized side of the ledger right now. I'm not an anarchist. I want a balance between centralization and decentralization. But I think the pendulum has swung way too far to the centralized side, as evidenced by the user as product business models that I think, are causing teenage girls to commit suicide and are causing, most individual investors to not maximize their profits in the markets. Okay. So meanwhile, I'm developing a business. I'm going to be raising capital soon. Why should I, as an entrepreneur, build my business on a decentralized model? Or do I just sort of bring in some decentralization, but pursue a more traditional business model, right? So I'm really interested in learning from you guys how a DAO could really help, one, the mission that I'm trying to achieve, right? But also help me build a business.
Right. That's great. Well, that's the kind of the key to our community is community, right? So it's helping each other out and answering questions like this. A lot of the time it comes down to, what's your marketing vehicle and what's your incentivization structure? Because if it's truly for the benefit of the people, then, people will hop on board and take part in that fight for you. So if folks do want to learn more or get involved with what you're doing, maybe at some point there will be some sort of tokenization, maybe there will be some sort of airdrop, who knows? But for now, they can go to drrichardsmith.com. That's drrichardsmith.com, correct? Any other places you'd like to send people?
And also RiskSmith.com. That's where we're developing the financial technology. We have a wait list there that you can get on and stay in touch with us. And as soon as we're ready to let more people in, we've got some beta users right now, and we're letting people in, slowly, and hopefully more quickly in early next year. So both those places, you can check it out. Love to learn more about, I am thinking a lot about tokenization, for example, and how can I, possibly have a tokenomics around portfolio construction and risk design, right? And have a community, and also even in investment selection, right? How do we, I think we all share a lot of common values, right? And I personally don't want to invest in Facebook. I don't want to invest in Robinhood. I don't want to invest in really, any of the big FANG stocks right now. I don't want to invest in Netflix, Google, because I don't trust them, right?
Right.
And look, we individually, we don't have the capital that, the big whales have, but collectively, we have a tremendous amount of capital. Individuals control the majority of the capital in the world.
Collectively,
right? We just turn it over to some other.
We can certainly, move the needle. I think,
and index funds. I hate index funds. It's you talk about herd, mentality, right?
Right.
So
right. Exactly.
I believe that investing should be about influencing the future.
Right. I agree.
And,
well,
so that's another area I'm really interested in.
Yep. Right down there. Let's see that right down there. It's Daoists.xyz. That's where I recommend you go, Richard, and anyone else interested in learning about DAOs and Daoism, a growing resource base and answers to questions about tokenomics, and does it make sense to tokenize, and when does it make sense to tokenize? That's one of the key, I think, elements that comes into a model where you're trying to incentivize a community, is that it's kind of a chicken and egg situation, in that you probably want to establish a community before you reach out and branch out to allow people to join that community, because nobody wants to join, a community that doesn't exist. Yet at the same time, you need to open the doors to allow people in and to take part in things. And so you don't want to tokenize too early, because you don't have necessarily enough value to incentivize. So, and all of this is being developed on the fly, where at the very early stages, there's a lot more to come on Daoists.xyz. But if you're part of the community, you join our Discord. I think you can learn a lot and be in the company of some really great individuals, great thinkers, and we'd love to help you figure it out for your community and for democratizing information about investors and really take it out of the hands of folks like Robinhood, so that we don't necessarily have to keep sacrificing our profits, really. Well, thanks
Sounds
so much.
great. I love
Richard.
it. Really
Yeah,
appreciate
thanks.
it. And
Thanks
I'll
for
definitely
coming on the
join.
show. Yep, we'll be
Thank you.
having you again soon for a follow-up call. And we didn't get to touch on your co-founder Justin Davis, but we wish him the best. We understand he's traveling, so safe travels to Justin. Thanks, Richard, and we'll see you guys all soon. I'm Igor Alinsky, your host, and be back next time.
Thanks for having me.